QE and the Great Wealth Shift. Quantitative easing is when central banks create digital money to buy bonds and assets to stop financial collapse. It began in 2008 to rescue banks and markets. Instead of reaching everyday people, most new money flowed into stocks, bonds, and real estate. That lifted asset prices and made wealthy asset owners much richer, while wages stayed flat and savers earned near zero. QE effects. Asset boom. Trillions created raised stock and housing prices, pricing many young buyers out of markets. Wealth transfer. Money reached banks and investors first, so the top 1% gained most of the benefit. Cheap borrowing. Governments and corporations borrowed at low rates, fueling deficits and share buybacks instead of broad investment. Dependency. Markets now depend on central bank action. Hints of tapering trigger crashes. QE became a permanent backstop, not a temporary fix. Consequences. Inequality widened. The bottom half owns little of the asset gains while the rich captured most of the returns. Financial distortions. Bond yields collapsed, pensions and insurers struggled, and risk moved into asset markets. Global volatility exported. Hot money flowed into emerging markets, then fled when policies tightened, creating boom-bust cycles abroad. Moral hazard. Firms and investors expect central banks to bail them out, encouraging risky behavior. The trap and the future. QE bought time, but not structural fixes. Each round requires more to have the same effect. Inflation and debt saturation are growing risks. Possible outcomes include prolonged low returns, higher inflation, or a forced reset if confidence fails. Moving to digital currencies and programmable money could deepen central control over liquidity and distributions. Bottom line, QE stabilized finance, but concentrated wealth and made the system dependent on endless liquidity. It solved crises short-term, but increased long-term fragility and inequality, leaving policymakers with fewer options when the next shock hits.